Good morning and welcome. My name is Cameron Farah. Joining me this morning is Neil Brown, who is the Head of Private Equity at Federation Asset Management. Federation is a private markets firm that specialises in investing in businesses that meet a social and economic need in three main channels: renewable energy, real estate and private equity. And it is this last one that we'll concentrate on today. Federation is built from a significant core of Macquarie Group's principal investments team that spun out in 2018 to form Federation Asset Management. As mentioned earlier, Neil Brown joins me this morning. Neil acts as the head of private equity there at Federation. He's a founding member of the group. He has more than a decade's experience in investment management and corporate advisory across a wide range of sectors, including energy, infrastructure, transport, financials and real estate. Good morning to you, Neil.
Morning, Cameron, and thanks for the intro. Good morning, everyone, and thanks for joining us also. The purpose of today's discussion is to take you through Federation's filtering process for finding and structuring investments, in particular as it relates to our private equity efforts. Perhaps to set the scene, made 6 investments to date across our broader platform, 4 of which we'll be discussing in some detail today. These investments include Windlab, Sendal, RateSetter and George Health. Broadly, the portfolio is performing well since we've made those investments, and we think they remain well placed to see continued growth over our investment horizon. Turning now to how we approach investments and the filters we apply in making investment decisions. Our core objectives are to protect capital in the first instance, and then to turn our focus to maximising risk-adjusted returns. So how to best structure an investment and our own participation to maximise returns for a given level of risk. An important part of our process is the application of ESG principles. So that is an application of environmental, social and governance principles that go to the sustainability and impact of an investment or business. We feel that an application of this lens is not a trade-off between returns and impact, but is actually more likely to protect capital and provide superior risk-adjusted returns. We believe that investments in sustainable sectors, in businesses that take account of needs of broad stakeholder groups, are more likely to be good investments than those in sectors in structural decline. So in addition to the ESG lens, the filters we apply include first, our own experience in that relevant sector. So whether we have an existing understanding of that sector and we're therefore alive to the risks and return potential, and also the value add that we personally can bring to an investment. As an example, none of the team have experience in consumer goods or traditional retailing, and so you'll never see businesses from those sectors entering our portfolio. The second filter we apply is a macro lens regarding outlook for a sector or an addressable market broadly, and whether we see medium to long-term growth in that broader sector. That will mean companies within that sector are more likely to grow. An example here is, or perhaps a negative example is the coal sector. We see that as a sector that's in structural decline, and so we won't invest in that sector from both an ESG perspective and also from a macro filter perspective. The third lens we apply is then the micro lens. So do we think the business or investment is of a quality, is of good high quality, and also the management team of that business that will allow it to grow faster and more sustainably into that broader growing sector than its competitors. So deep diligence on business quality, business model and management teams. And finally, we apply an investment structuring overlay. So once we are comfortable that we like the quality and prospects of a business, how do we then structure that investment to maximise return and minimise risk? And also, of course, it needs to meet the needs of the investee company so that there's a meeting of minds and we can agree to do a deal. From a practical perspective, we apply these filters through a pretty structured 3-stage investment committee process. Effectively, they're gates for determining whether the team spends time on an investment, whether we then move to the more detailed due diligence process, which typically requires expenditure on legal and technical advisors, and then finally, if our investment hypotheses are remaining after that detailed due diligence process, finally whether to enter a binding commitment with the company on a structure that we've negotiated with them. So turning to slide 4, we've discussed a few sectors there that we don't invest in, turning now to those where we do see opportunity. Given a crossover of both our own team's experience and also sectors that we think will experience macro growth. These include healthcare, where the team have invested in companies like Genesis Care, which is a large radiology and oncology business, and various other primary and tertiary healthcare businesses. Financials, where we have a deep experience in financial services with the Macquarie background, in particular lending businesses and financial infrastructure. Third, in renewable energy, where we see a really huge growth opportunity in the Australian market and where we have a long history of advisory and investment experience in the energy sector more broadly and in renewable energy development. Transport, logistics and infrastructure is another strength, as well as aspects of technology or technology-enabled businesses related to those sectors where we have experience. And finally, probably education would be another sector that we'd add to that list. This slide then gives you a feeling for our origination funnel and how the filters and investment committee process take us from a very large number of opportunities in the top of the funnel and then narrowing to very few actually being transacted. So to pass that initial screening phase, the deal team will have a high level positive inclination towards that experience lens, macro lens, and an initial positive view on a micro filter around the business model. And the detailed stages are really then around testing those hypotheses, as much evidence as we can find, and then structuring and negotiating the commercial deal to get us through the final investment committee stage to make a committed investment. Perhaps now turning to our individual investments and giving you a feel for how those filters applied in making those investments. Our most recent in Windlab. This one probably straddles our PE and renewables efforts at Federation. The company itself is a developer and asset manager of wind farms in Australia, the USA and Africa. We're attracted to the business because of the really large size and quality of its portfolio of development assets here in Australia. And the company's also demonstrated very strong performance of the wind farms that it's built and now manage in this country. They're some of the highest capacity factor wind farms in the national electricity market. Windlab was an ASX listed company. We recently completed a take private of that business and acquired 100% of that business. The strategy there is to focus the business in on its large Australian development portfolio and to bring the capital and the commercial and financing expertise to assist in that exercise. Regarding our filters, they're In terms of ESG, we see the opportunity for attractive returns in a sector that's strongly aligned with ESG principles. So not only is it sensible from an economic perspective, but also from a decarbonisation and environmental perspective. We have a long period of expertise in the energy sector broadly. Various members of our team have spent a long time advising and investing in energy and renewable energy businesses, including in the wind farm development process. So very, very familiar with that activity. From a macro perspective, and for those that were online for our session last, detail about the Australian renewable energy market and the opportunity there. But in summary, there's a real and material requirement to replace electricity generation capacity that will be coming out of the Australian market over the next 2 decades as the coal fleet reaches the end of its useful life. And we spoke about how renewables are the logical source of replacement capacity, both from an economic perspective, in that it's the cheapest cost of a unit of electricity to produce, and also from a decarbonisation perspective. So from a micro perspective then, as we mentioned, Windlab has a very large development portfolio of wind assets, the largest in the country, with 4 gigawatts of capacity in that portfolio. They're high quality projects. The management team has been together for a long period of time and have strong experience in their business. And finally, from a structuring perspective, we were most attracted by the ability to create a call option shape in this investment. We felt that the listed market appeared to be valuing only the company's operating assets and its asset management business and placing very little value on the development pipeline. And through monetisation of some of those more non-core international assets, we feel like we can create an extremely cheap entry price into the real assets of substance, being that Australian development book. Further, we were able to leverage third-party capital to sit alongside Federation investors in this deal to make Federation's dollar go further, with Andrew Forrest, Squadron Energy, investing alongside us in the business. We have Federation representatives now sitting on the board of that company with controls over important decisions. Turning now to Sendle. Sendle is an e-commerce logistics business. It delivers parcels for e-commerce businesses to their end customers in a cheaper way and with better service than the incumbents. It has an interesting business model, so a capital light business model where Sendle owns the customer relationship and is responsible for end-to-end delivery of a parcel and customer service along the way. But rather than owning their own trucks and warehouses and post offices, they contract for existing spare capacity in courier and logistics networks. So really using marginal cost spare capacity in existing networks to service their customers. And this means the business has operational leverage advantages where it can grow rapidly without layering on lots of additional fixed cost and capital intensity, and is able to benefit both their customers and their courier partners as they drive greater volume through those partnerships. The business has been performing very well since we've invested, on average 50% growth on prior corresponding period historically. COVID-19 has actually been a large positive for this business. E-commerce penetration has grown a great deal over the last couple of months, and that's resulted in a commensurate increase in the requirement for parcel delivery. So you can see really material growth on prior periods over the last few months. Contributing to that growth, aside from COVID, have been the business entering some exciting partnerships with large drivers of demand in eBay and Shopify, where Sendle's the preferred shipper on those platforms, with those platforms being really widely used by Sendle's e-commerce customers as their shopfront and business management platform, which has benefits for cost of customer acquisition as well. They've made a very promising start into the US as well. Federation's capital at the time of investment was to be used to continue the growth in Australia and to make that US entry, and so we're pleased with the way that the management has been executing on that strategy since our investment. Turning to our filters from an ESG perspective, Sendle is Australia's only 100% carbon neutral delivery service, in that they offset 100% of the carbon associated with their activities. They're also a certified B Corporation, meaning they balance stakeholder interests, including employees and customers and suppliers, and the community when determining and executing on their strategy. Regarding sector experience, the Federation team has had experience in transport, logistics and infrastructure businesses, and investments in both credit and equity investments in those businesses. From a macro perspective, e-commerce is already a huge sector globally, but growing strongly with strong tailwinds. The SME parcel delivery sector is a $4 billion market in Australia, and a $180 billion market in the US. And so we see real opportunity to grow into a very large addressable market in those markets and further elsewhere around the globe as the business continues to grow. From a micro perspective, we like the capital light nature of the business model, and we're very impressed with the quality of the management team and their ability to execute on strategy, as we mentioned. Finally, from a structuring perspective, we entered at what we feel is a sensible valuation relative to comps. We have a seat on the Sendle board, and we have negative control rights over key decisions on that board. So where we have conviction over the business growth prospects, we're comfortable being edge of value equity and making the most of that upside potential. But we like to put in place those governance controls rather, like board participation, so that we're able to contribute to the direction and have oversight in a meaningful way of the business. Turning to RateSetter. RateSetter is one of Australia's fastest growing non-bank lending businesses. It offers three main product lines: a personal loan product, a secured auto financing product, and a renewable energy product that finances solar and battery installations for residential borrowers. It has a diversified source of funding for its loans on its borrowing side, including from retail investors, where you and I can invest money on the platform. They have wholesale and institutional investors like credit funds, banks and super funds. They have the Clean Energy Finance Corporation investing in renewable loans, and they have a large warehouse facility from a Big Four bank to further expand and broaden the business's funding capacity. So the business is growing strongly into those product lines and has a broad and deep funding capacity on that side of the business to continue that growth. An aspect of the model that we really like is the provision fund that RateSetter has, where a proportion of returns on all loans written are placed into a trust for the benefit of investors, and that fund then provides protection in the event of borrower defaults on the lending side of the platform. You can see the chart in the top right there. The business continues to grow its book rapidly, rapidly. It's up around $400 million currently, and it does this while focusing on the high credit quality segments of its product line, so maintaining strict credit underwriting standards and in high credit quality borrowers. With respect to COVID, while loan volumes came off during peak COVID in March, we've seen those volumes return, and importantly for a lending business, defaults and hardships have remained at levels lower than the broader market, and indeed the provision fund remains well provisioned for expected losses as they arise. So now, considering our filters from an ESG perspective, the renewable energy product line is an important aspect of the business. RateSetter also manages a number of the state government renewables and battery programs, including for the South Australian government, and also a pilot project for the New South Wales government. So I think they're well credentialed in that segment. Further, we mentioned the credit quality of borrowers. So in the personal loan business, that's focused on high credit quality borrowers at low interest rates. And it was important for us from a social and economic perspective that the business doesn't play in the poorer credit quality, punitive interest rate segment of the personal loan market. With respect to experience, a number of the team have deep experience in financial investments, in particular lending, mortgages and receivables business from our Macquarie background. From a macro perspective, the addressable market is very large. Personal credit's a $100 billion per annum market in Australia, of which the bulk is still provided by banks under less efficient and less agile business models. So we see a real opportunity to grow in that market. And then from a micro perspective, we like the RateSetter model. The company owns its own technology stack. It's a great experience for its customers in terms of a digital end-to-end experience. The provision fund model, as I mentioned, that protects investors' capital is an attractive part of the business model. And also just that the business had shown years of track record and growth and had lent a little under $500 million at the time that we invested. So we compared it to some of the other finance business alternatives that have been raising money over the last 2 years, and felt that they had a demonstrated track record and ability to continue to grow that we like. In terms of structure, like Sindel, this is a business where we envisage material growth over our investment horizon. Our investment is made as ordinary equity, but again, we have a seat on the board. Turning now to slide 9, George Health. This group comprises a number of businesses. The first is George Clinical. George Clinical is a contract research organisation. Contract research organisations perform the trial design and project management role for pharmaceutical and medical technology businesses when they need to perform R&D and when they need to perform trials to achieve regulatory approvals for their products. The company is global in footprint, but with a focus on Asian markets, both because Asia is becoming an increasingly larger end market for pharma and medical products. And so Asian-focused businesses or the sector is growing at a faster rate than the broader global sector. Asia also relevant because it's a source of trial participants that are needed to run those trials. The second business in the group is George Medicines, a late-stage pharmaceutical development business focused on chronic diseases like blood pressure and diabetes. So this business has a number of pharmaceutical products, 3 or 4 that are in the late stage of trials and development and commercialization. And the business continues to complete those trials and looks to commercialise those products. The group also has a business commercialising a medical device in the kidney disease area, and a business developing a medical software platform. Perhaps turning to structuring here, as it's probably a more interesting structured investment than the active equity investments that we've discussed on prior slides, in that we've invested in George Health by way of a secured convertible note. And that means that the investment acts like debt as it currently stands. So it has security over assets and earns an 8% interest rate. But we have the right to convert to equity and enjoy the upside associated with equity when we wish to do so. So we have a 4-year window to decide whether to access that equity conversion right or maintain our position as a secured loan earning interest at 8%. Clearly, our interest is in the equity upside potential, but we wanted to structure our investment with that downside protection at still a sensible return. The reason we structured the investment in this way is that we do want exposure to the upside of those 4 uncorrelated bets, but we want the downside protection of secured debt in the interim. The reason for that is while we feel like that we can strongly value the CRO aspect of the business and to some extent the pharma development business, we wouldn't have invested in straight equity in pharma development or the other businesses alone. And so by structuring the investment in this way, we effectively place no value on those other pieces, but still share in the upside if they pay off. Now, with the benefit of hindsight, that's been a sensible decision to structure in that manner. COVID has had an impact on the company's earnings, but we do feel well protected and have a 4-year time horizon on the investment on that equity conversion decision, and so the prospects for the business remain sound. Turning to slide 10, this is a summary of our pipeline. We have actionable opportunities across our areas of expertise. There are a number of healthcare opportunities in the pipeline, a large-scale financial opportunity focused on servicing an ageing population, a financial infrastructure technology platform, and a number of opportunities to add to our Windlab platform that we currently have in due diligence. Finally, just before finishing off on the formal presentation, I'd mentioned that we apply similar filters to our real estate investments in childcare and disability accommodation. We have a strong focus on tenant quality and long-term leases with government-backed income streams, and we structure those investments to involve ourselves in the development phase of the projects in order to create assets at a price cheaper than the market pays for completed assets. So commercial structuring to give us what we feel is a benefit in terms of creating assets at a value more attractive than the market is pricing them. And perhaps finally, to summarise the reasons why we believe people should invest with Federation, we have an experienced and successful team who's worked together over a long period with expertise in the sectors in which we invest. We've got a track record of strong performance at Federation and in our prior roles across more than $2 billion of equity investment. We have a high quality governance structure and process around making investments and the operations and asset management that supports those. And finally, a portfolio that's performing well with a number of actionable opportunities in our pipeline that investors would gain the benefit of. So with that, I'll turn to Cameron to see if there have been any questions.
There have been a number of questions come through, Neil. Call them up here. The first question that's come through is, could you please give an example of an investment that didn't pass through your filters? Perhaps just the sector rather than the name.
Sure. Yeah, typically it's probably the business quality, the micro business quality filter that prevents us from progressing, and sometimes also too big a gap on valuation expectations between us and the counterparty. One that comes to mind was in the education space, a private tertiary education provider. The business passed the ESG and macro lenses, and that micro business quality lens, and we were spending detailed time on the business itself. The deal fell over on that perspective, and also probably on the structuring lens. The business was quite dependent on one country in particular for sourcing international students, and so we were concerned about some issue happening that would impact students in that particular country, whether it be something occurring in that country or something occurring in Australia with that group, and that having then a really material impact on the earnings of the business. And so that being what we felt is probably a bit of a binary risk in mind, we couldn't then agree a structure with the vendor to de-risk that issue for us. They would only entertain a straight equity deal at a valuation that we thought didn't provide enough cushion for that binary risk. So that was one that we couldn't get comfortable with and passed on.
Excellent question here on valuation. How do you value these companies regularly between when they raise capital?
Sure. The way we value companies is really by applying the same multiples that we applied when entering the asset to then the metrics over time as that business evolves. And so we effectively maintain the constant multiple against things like book size in the instance of rate setter and revenue and parcel volume in the case of Sendle. And so, effectively applying that same multiple to those metrics as we hit each of our quarterly reviews. I would add that for our March review, we did a review of the external comps and how they'd moved relative to when we made our investments, and we found that in the case of Sendle, first we felt like we had purchased well in terms of comparable valuations, but also there had been quite a large increase in those comparable multiples over the period between our investment and sort of pre-COVID. And so we hadn't marked up our position based on expanding multiples in the broader sector. And so when those multiples have come off at the start of March and often returned since then, but in that early COVID period where listed equities had come off a lot, those multiples implied that they'd come back, but still not above where our multiples were initially. So we hadn't marked up for the benefit of multiple expansion, and therefore didn't see the need to mark down for the retraction in multiple. In the case of rate setter, on that same lens, we felt that while there had been a big expansion in multiples, in the period between December 2018 and January 2020, the multiples had come off in that period to March. And so we did actually apply a discount to our entry multiples and our rate centre valuation by a 9% discount to our entry multiple valuations on that company as well. With respect to Windlab, it was a listed business. It was initially marked at the 80-cent price that we made our initial investment. The transaction has been completed at a $1 price, and so that asset will be marked to $1 per share on completion of the transaction shortly. And then finally for George Health, because we hold that as at the moment as a debt instrument, effectively we just accrue the interest on that position. So the 8% interest rate that gets accrued is the basis for holding that investment. On our real estate investments, we're still holding real estate at cost.
Excellent, thank you. Rate set a specific question. How much does the renewable business line make up of its overall portion? And do you anticipate this to grow?
Yeah, in terms of it's a newer business line, and so it would make up, a 10-ish% proportion of the overall book at the moment, but it is growing. It's a more than that percent of monthly originations, and so. Yes, we do see that business becoming a more and more material part or more and more material product line in the mix of investments. Interestingly, during this COVID period, volumes in that channel have been growing very rapidly. So, we think that's a little bit to do with the sort of DIY people being at home exercise, but also the fact that installing solar panels and particularly if you can finance them, it has an immediate impact on the electricity bill for the household as well. So it's an expenditure that is increasing people's disposable income by doing that and reducing their electricity bill. So it's been showing strong growth over the last couple of months.
Excellent, thank you. There's a final question here on platforms, which I might take there, Neil. You'll see my details on screen here. If you do have further questions, including on the platform side of the fence, we are going out to a number of platforms at the moment and are in discussions with them. Hub24, it's available there. We're in discussions with Macquarie, BT Wrap, Panorama, those kind of organisations. If there are some specific platforms that you would like to see the fund available on, please do let me know. Federation is in a raise process at the moment that completes at the end of July. That will be based off a March unit price. As Neil has just mentioned, there has been some positive benefits for the portfolio through COVID. So if there are further raises to follow at the completion of this July raise, it will be based off the June unit price, and Neil has just taken us through the portfolio performance there, which has been positive through that period. So if you can move pre-end of July, there will be benefits to you or your clients. If you do have any questions at any time, my details are on screen. Thank you very much for your time this morning. Thank you, Neil. We look forward to speaking with you soon.
Thanks, everyone.